The screen says silver is 62.30, but try buying a single real ounce. The price didn't fail. The system did. Yesterday felt like a victory lap. We told you the pressure finally cracked. We said the banks had lost control, that the manipulation era had reached its breaking point, and on paper it looked true. Silver didn't collapse. It held firm above 62. You looked at your account and thought, I've never been wealthier. But today brought a very different reality. The phone stopped ringing. Websites went dark. Dealers stopped answering. And suddenly one simple challenge exposed the truth. Take that 62.30 and try to buy a physical ounce of silver right now. Not tomorrow. Not pre-order. Right now. Call the largest wholesalers in North America. Reach out to Swiss refiners. Try the Australian mints. What you'll hear isn't a quote, it's silence. Or a recording explaining that due to extreme volatility, new orders are suspended. This isn't a glitch. This is what happens when the system breaks. What we're witnessing isn't a lack of silver in the ground. It isn't even a true shortage yet. It's something worse, a complete liquidity failure. The physical silver supply chain has snapped clean in half. Refiners have stopped accepting orders. Wholesalers are canceling deals that were locked in just yesterday. Reports indicate the U.S. Mint is effectively frozen under allocation. And the reason sounds backward, the price moved too fast. Under normal economics, higher prices attract sellers. That's Econ 101. But silver doesn't live in Econ 101. It lives inside a leverage, heavy structure held together by hedges, margin agreements, and trust. At 62, that structure didn't stretch, it shattered. This message may be the most important warning I've ever delivered, because 62.30 isn't the price of silver. It's the last recorded location of a market that just vanished from radar. If you're waiting for a pullback, you didn't miss the window. The window was sealed shut. Let's define what's happening on the ground. A functioning market needs two sides, bids and asks. Buyers and sellers. Liquidity exists only when both show up. As of today, silver has gone bid only. There are millions of buyers waving cash at 62, though 65, even 70 due, and no sellers stepping forward. A senior contact at one of the largest precious metal distributors in Texas confirmed it plainly: all sales halted. Their hedging line with a bullion bank is maxed out. Replacement metal cannot be sourced. The website is closed indefinitely. Think about that. Silver is at record prices, and professional sellers are refusing to sell. The reason is replacement risk. Picture a dealer with inventory bought months ago at 30. Selling today would lock in enormous profit, except tomorrow, replacing that inventory could cost far more. If price outruns restocking ability, the dealer dies. You've traded a rapidly appreciating asset for a collapsing currency. Veterans of 1980 and 2011 recognize this trap instantly, so they hoard. Inventory becomes strategic reserve. The metal still exists, it's just no longer available. This is why you're seeing pre-orders, with delivery dates months out. And understand this clearly, clicking that button isn't buying silver. It's issuing an unsecured loan to a dealer who doesn't have the metal. The break begins at the top of the chain, the refiners. Refiners don't speculate. They fear volatility. Their business model depends on stability. When a refinery buys raw silver, it takes weeks to process. During that time, price risk is deadly. To protect themselves, refiners hedge. They short paper silver the moment they acquire physical input. This works when price moves slowly. It fails catastrophically when price explodes. As silver surged through the 60s, refinery short positions began hemorrhaging cash. The physical metal sitting in furnaces doesn't satisfy margin calls. Exchanges demand cash immediately. Tens of millions, overnight. Refineries don't have that liquidity, so they stop buying ore. Production halts. Bars stop flowing. The paradox emerges: the higher silver goes, the less silver gets produced. We saw hints of this in 2020 and 2021, but at 62, the capital requirements are exponentially larger. Margin calls are lethal. Refiners are frozen until volatility subsides, and volatility isn't subsiding. Below them, wholesalers are panicking. Mints that accepted hundreds of thousands of ounces in retail orders suddenly discovered their upstream supply vanished. They took cash. They don't have metal. Refunds mean handing customers a melting currency. Delays mean allocation, emails, the industry's quiet confession. Meanwhile, industrial buyers aren't waiting. Tesla, Samsung, major solar manufacturers, they don't buy coins, they buy 1,000-ounce bars. And they're paying whatever it takes, or 65, 70, 75. Immediate delivery. No hedging. Pure survival. Retail buyers aren't competing with coin shops anymore. They're bidding against global industry. And industry wins. This drains the last liquidity from retail channels. Premiums explode. Spot stays at 62 while eagles push toward 100. That's not exaggeration. It's arithmetic. Now we enter the legal danger zone. Force majeure clauses exist in nearly every bullion contract. Extreme volatility qualifies. If declared, counterparties can settle in cash at a price of their choosing, not the market's. Imagine silver at 100 next week. A fund settles your claim at 61.75 because that was the last official price before disruption. You lose the metal and the upside legally. This is why unallocated silver, ETFs, and futures contracts carry massive counterparty risk. At this stage, owning promises is more dangerous than owning nothing. Margin requirements are already rising. Exchanges are preparing emergency measures. Force majeure is the escape hatch. And once defaults begin, even small ones, cash settlement spreads like wildfire. This marks the divorce. For decades, spot price and physical price moved together. Now they've separated. Spot is a screen number traded by algorithms. Physical price is what you negotiate face to face. Today, that number is far closer to ADD. When spot drops and premiums rise, waiting becomes fatal. This is backwardation, immediate possession valued more than future delivery. It signals trust collapse. History shows where this leads. Official markets empty. Unofficial channels take over. We're not fully there yet, but refinery shutdowns are the opening act. This morning, the silver market crossed its event horizon. Once crossed, reversal becomes impossible. What comes next isn't stabilization. It's unobtanium. Unobtanium describes materials essential to civilization but impossible to source. When commodities enter this phase, price doesn't climb, it leaps. Rhodium showed us this. Silver is next. Solar factories can't shut down. Defense contractors can't pause. Electronics manufacturers can't wait. They don't feel FOMO, they feel extinction pressure. Already, reports indicate tech firms are bypassing refiners entirely, offering to finance mines directly. The supply chain is being rewritten in real time. When price becomes inelastic, no level stops demand. If physical becomes unreachable and futures become unaffordable, capital flows to miners. For years, miners were abandoned, underfunded, shorted. Now at 62 silver, their margins are astronomical. Earnings haven't caught up yet, but they will. And when they do, valuations won't climb, they'll reprice vertically. But selectivity matters. Hedged miners miss the upside. Political risk matters. Safe jurisdictions command premiums. Mergers and acquisitions are coming. Industry will buy supply at the source. This is the secondary wealth transfer phase. And don't think the system will surrender quietly. Margin hikes, position limits, regulatory threats, ETF rule changes, media panic. These tools aim to crush paper demand, not fix physical scarcity. They can't print silver. They can't regulate ounces into existence. Every intervention worsens the shortage. The path forward is clear gamma pressure, media mania, industrial capitulation. Not smooth, not calm, but structurally locked. The real question isn't how high silver goes, it's what you trade it for. Selling silver for dollars during currency debasement makes no sense. The smart exit is swapping. Silver for gold, silver for land, silver for productive assets. History shows the ratios reset violently. We are living through a generational inflection point. December 11th will be remembered as the day the supply chain failed openly. For those who prepared, this is validation. For those still waiting, understand this easy silver is gone. Volatility will test conviction. Headlines will scare. Screens will lie. But physical reality always wins. Hold steady. Protect what you own. The greatest wealth transfer of our lifetime is underway, and it doesn't care about paper prices.